Welcome everybody to our next live stream. We're going to be going over the 10 signs that not just a recession is coming, but we could be facing another depression coming or Great Depression. So just confirm you can all hear me, type 1 in the chat, and we will continue with the show. Because again, we've got these 10 crucial signs that shows things in the economy are going from bad to worse. You can all hear me. Fantastic. Well, ladies and gentlemen, without further ado, I think you know what time it is. Thank you for all joining me on a Friday night if you're in the US, or your Saturday morning here in Australia. And let's get straight into the news, the facts, and the data. Well, okay. First things first, we're going to go over what happened in the markets today or yesterday overnight if you're watching from Australia, because some big things happened. There's some big things happening in the markets, so we're going to discuss all of that, and again, also go over those economic indicators that are signaling some very interesting and tough times ahead. So look at this. We can see the Dow. It plunged nearly 300 points, but who was affected worse? The S&P 500 down 1.22%, and the NASDAQ was hit even harder, down 1.5%. So now we'll go to the bond market. Bond market yields tipped higher, and they're getting to those dangerous levels. So again, like I said, once it hits 4.5%, well, the markets are going to be in big trouble. Now, we can also go ahead to oil. Oil is still surging strong. See, it's getting very close, Brent crude, to $100. That's going to mean more inflation. And again, like I went over in my video previously, I think it was yesterday or the day before, the central banks have officially lost a battle to inflation. And I don't know if they're going to be able to stop it now without causing either a Great Depression or a financial crisis. But some good news for all my gold and silver investors. It was a good day for gold and silver. While stocks were tanking, gold and silver was doing well. And also Bitcoin over the past couple of days has been rebounding strong. It did briefly dip below 25,000, which was quite a worrying technical level the other day, but it is bouncing back strong over $26,600. So again, all indices were down. Bond yields surged yesterday. Oil is still surging. Gold and silver's holding up, and crypto's holding up. Now, and because gold and silver did such a great day yesterday, I just want to quickly announce I've never done this before, 85% discount off my classes on how you can master the Trinity portfolio by using gold, silver, and Bitcoin, because again, things are going to be getting very tough coming ahead. So you definitely going to want to know how to master the cycles of gold, silver, and Bitcoin. And again, this is valued at $999. I'm doing 85% off, only $149. I'm trying to make prices go down because I see all these YouTubers increasing their prices for their courses every single week. So I thought, instead of, consumers having to deal with inflation, let's bring on some deflation. Okay, so it's 85% off. I'm only doing it for 24 hours. Again, I barely promote this course anymore. I don't really promote it. I don't really do discounts, but my gold and silver portfolio was doing good yesterday, and the Bitcoin portfolio, so I thought I'd do that to celebrate. So you can just click the top link in the description to get that coupon code. So okay, let's get into this, everyone. The 10 signs the US economy may struggle in the next year. So go ahead and type 1 if you think there's going to be a recession, or type 2 if you think there's going to be a depression in 2024. So again, 1 for recession, 2 for depression. What do you think it's going to be? Okay, 420. I don't think it's going to be 420. 2. A lot of 2s. Okay, so you guys can see that. And it's quite funny when I do these live streams. After they go up, I see a lot of people commenting in the comment section 2 or 1 as well. So, okay, what exactly are these signs? Now, again, all these signs I've been trying to warn you about, so I'm sure you can pick up on some of them. So, okay. Sign number 1. Can you guess what it's going to be? What is sign 1 going to be? Wow. Okay. Households running out of excess savings. So I'll go ahead and modify that so we can get rid of that annoying ad. Now, this is what we've all been seeing. We've been seeing the US personal savings rate. This is not just happening in the US. This is happening in Australia. This is happening in Europe. People had huge amounts of savings during COVID because of all the stimulus checks and because they couldn't spend money even if they wanted to. So first thing, they're not going to have the savings to get them through the depression that is coming. And when unemployment ticks up because they're dwindling their savings because of inflation. So that's the first indicator, but what do you think is going to be the next indicator? Well, let's have a look. What's the next indicator, everyone? Ooh, student loan repayment starting. Now, this is going to start in October, so don't get this confused. Just because repayments start in October doesn't mean the crash will happen in October. It'll probably take a couple of months for us to start getting that data to see how the consumer is holding up with these higher student loan repayments. But again, if their savings is down and they're going to have more costs, well, it's just simple supply-demand economics. We're going to see a contraction in the consumer, and that will lead to deteriorating economic activity. So what could be the third indicator, everyone? Let's have a look. Ooh, delinquency rates rising for credit cards and auto loans. So, okay, if people are defaulting, that tells me that they're in a very tough financial situation, and really they've got no way out. So data reported by the New York Fed showed that the rate for new credit card delinquencies rates was 7.2% in the second quarter of this year. Now, this is more than the 4.8% in the second quarter last year. And I think we're going to see delinquencies rates for credit cards and auto loans absolutely skyrocket because interest rates are skyrocketed because of inflation. People are spending so much on the essentials. All those people that went and brought all those luxury items during the pandemic and brought that brand new car, well, they're simply going to default on them because they can't afford the repayments anymore. And these are getting very, very close to the delinquency rates we saw in 2008. So, okay, that's a third indicator. What could be the fourth indicator? Let's have a look. Wow. Okay. Defaults rate rising for corporate loans. That's something else we've been talking about. The commercial real estate sector is in big, big trouble because what you have to know is for commercial real estate, a lot of those mortgages are adjustable rate mortgages, unlike the residential sector where a lot of 30-year mortgages are fixed. With corporate loans, a lot of them are adjustable. Now, also, what a lot of corporations do is they issue bonds, just like the government issues bonds, which is debt, and then they say, we'll repay you back your money on this bond plus interest. Well, a lot of corporations, they issued debt and they took on huge amounts of debt during 2020 and 2021 when interest rates were so low, but now interest rates are so high, those interest payments are starting to make up a huge chunk of their income, which we'll get into later in the video. So that's indicator number 4. What could be indicator number 5? Okay, indicator number 5, interest coverage ratios falling for both investment grade and high yield businesses' debt. So this is what I talked about. Interest costs are, really smashing these corporations. Because the conclusion, of course, is that we have seen a significant increase in interest expenses for investment grade companies, and that's why you started to see in credit a fairly rapid decline in interest coverage ratios. So what that simply means is the interest costs are skyrocketing compared to their income, and a lot of these zombie corporations that could only survive when interest rates were at 0 or 1, 2%, well, they're simply going to fail like they need to fail. We need to have some creative destruction to give opportunities for other people. Maybe you'll start a business, okay, when all these other businesses collapse. That's what capitalism is. You go ahead and, you want to start a business and you run it poorly, you deserve to fail. You shouldn't get special bailouts and special treatment by the bank and the governments that we can't get that kind of special treatment. So number 6, banking sector loan growth is slowing rapidly. Now, we all know the economy relies on debt. We're in a debt-based economy now, and debt has never been this high in history before. So if debt doesn't grow, you might as well say people aren't earning money, because I'm sure probably my subscribers, you're a lot better with debt, but the average consumer, like what we saw with credit card loans, auto loans, that's what they use to spend their money. They don't spend money on what they earn. They spend it based on what they can borrow, which is, financially the dumbest thing you could do. But if the banking sector loan growth is slowing, the economy's next. So what could be indicator number 7? Lucky 7. Wow. Like we were talking about earlier, oil prices rising. This is going to be very, very bad for the central banks because like we saw in the CPI report the other day, gas prices climbed 10.6% month over month. Now, I don't know if you've been driving past a gas station in the US or here in Australia, the petrol station or the servo. I drove past the petrol station and I can still see gas prices are rising, and they're rising rapidly, which is going to cause another uptick with inflation. And central banks have already lifted interest rates so aggressively, but it has not stopped the problem. So it's going to be either inflate, let the debt inflate away, or if they do try to lift interest rates, again, there's no way out of it. We will see a huge economic depression. Indicator number 8, China, Japan, and Europe are slowing. So China has been the economy that's made the global economy boom, especially Australia. The only reason why we avoided the 2008 financial crisis was because of China. But now with China slowing, with the deteriorating relationship between China and the US, we're going to see a huge contraction in global GDP. Now also Japan, they're contracting. And like what they say here, Japan is looking to invest in their own backyard. And here, look at this. They're selling US treasuries. Now, Japan is the biggest holder of US treasuries. And that's why even if the Federal Reserve does not lift interest rates anymore, if they sell US treasuries and bonds, we're going to see the 10-year rise. And it will be just the equivalent of the Federal Reserve doing another 1 or 2 more interest rate hikes. Now, also Europe. Well, we already know Germany's in a recession and they're the biggest economy in Europe. So if Germany continues in their recessionary state, well, that's going to create the whole Eurozone to weaken. Wow, it's not looking good here yet, everyone. So what could the last 2 indicators be? Let's have a look at what indicator number 9 is. Wow, okay. Long-term interest rates rising for non-economic reasons. This is very, very bad, everyone. So long-term interest rates are on the rise, even though economic data on a whole is improving. Well, do you agree with that, everyone? Do you think the economic data is improving? Yes, the economy is holding up better than expected, but on the other hand, inflation, the inflationary data is very, very bad, and it's a very mixed bag. And we all know their trick. They put out this great economic data only for it to be revised in about a month or 2, okay? So let's go ahead and read this here. So the Fed is still doing quantitative tightening, which decreases the money supply in the economy. We can all agree. We've seen with the M2 money supply chart, the money supply is shrinking. And again, even if they don't lift interest rates, if they keep selling treasuries, interest rates on the 10-year will rise, which makes interest rates on credit cards, auto loans, and mortgages increase as well. Meanwhile, the US recently received a long-term ratings downgrade by Fitch in August, 2 months after the latest round of debt ceiling squabbling in Congress. So that's exactly right. We saw the downgrade for the US government. We also saw downgrade for a lot of the banks. So this is big, big trouble, everyone. Again, even if the Federal Reserve and central banks stop lifting interest rates, if treasuries keep rising and there's more downgrades, we're going to see interest rates go up. So what do you think could be the last indicator to prove the Great Depression is coming, everyone? Well, higher interest repayments for the US government. Because look at this. This is an absolute joke, everyone. Nearly 33 trillion. It seems like every time I come back to the US debt clock, there's another $1 trillion on there. And if you think this is free money, no, look at this. Debt per taxpayer, $254,000. So do you know what's going to happen over the next 5 years? We're going to see taxes increase and it's going to absolutely destroy the consumer. We're already starting to see it. They're trying to figure out every single way they can to tax you more. In Australia, they're increasing the taxes. In Victoria, Dennis Dan, Dictator Dan, he's definitely increasing taxes in Victoria because the state is so heavily indebted, one of the most indebted states in the world. So we're going to see governments, not just the US, but all governments around the world, they're going to increase taxes to pay for this high interest rate costs. And what that also means is, unlike 2008, when they could create huge amounts of stimulus and bail everyone out, while interest rates are so high and the debt's so high, they're not going to be able to do that this time. So listen to this. High interest payments for the US government is another downside risk to the outlook. Projections published by the Congressional Budget Office show increasing estimates for the upcoming decades for federal interest payments as a share of GDP. So everyone, there you have it. 10 indicators that prove not just a recession is coming, but a depression. So okay, we're probably thinking, well, how can we prepare for this? Well, what you need to do, because very tough times are coming, you need to pay off debt, because debt is at such crazy levels, and also interest on that debt is at such crazy levels. If you've got any debt with an interest rate above 8%, don't even start thinking about in the markets, just pay off that debt first. Second, what you want to do is you need to figure out, because remember, the unemployment rate is going to tick up. There's going to be more layoffs. That could be you. So you need to figure out a second source of income and a third source of income. You could get a second part-time job. Maybe you could do Uber on the side. But really what you should start doing is figuring out a business you can create on the side that costs no capital to start. And with the internet these days, there's so many online businesses that you can create that doesn't take any capital to start, which means there's very low risk. You don't want to go and try and open a restaurant when there's going to be a recession coming, or opening a bar, okay? That is very high risk. It takes a lot of capital, and you don't want to be doing that going into a recession or a depression. And third, what you want to do is you want to start building your war chest of cash, because there's going to be so much opportunities. Even though there's going to be very hard times, depressionary times, remember, even if the unemployment rate goes to 20%, still there's going to be a lot of jobs out there for the people that are prepared, for the people that have skills, and there will also be great business opportunities and even better investing opportunities, because everyone will be forced to sell their assets for pennies on the dollar. But if you do those three things, you have no debt, so you don't have to worry about, getting foreclosed on or losing your house or having to sell your assets for pennies on the dollar. You will have additional sources of income. So that case, one income source gets right up, you have another source of income, and then you've got actual cash, because what normally happens in this depression is people have heaps of debt, they lose their income. So that means they have no cash when the opportunities are there, when the stocks are sold off for 60%, when real estate crashes 30, 40%, when gold and silver crashes, because gold and silver will crash in the short term because people have to sell that in order to cover their margin calls. But in the long term, gold and silver will spike up, and also cryptocurrencies. There'll be so much opportunities, but you need to have that capital there to take advantage of that. So everyone, that's what I want to talk about today. That's what's happening in the economy. That's how you can prepare. What do you all think about this? Thanks for watching. You're awesome. I'll see you all in the next video.